What's going on, guys? It's David Piatek and Lourdes Fernando, and today we're going to be talking about the thought process and the steps before you get pre-approved. Because we've done a ton of videos on the pre-approval process, what happens during the closing process and afterwards. But we want to kind of touch on things because we've had people recently ask us, like, I'm thinking about getting into home ownership. What are things do I need to consider before I go down that road? So, Lourdes, let's kick it off and start with one thing that people need to know or need to understand before they get pre approved.
Yeah. So one of the things is what is their plan? Long-term plan. Is your plan to stay in this as a starter home? Are you going to be in here 3 to 5 years? Are you PCSing anytime soon? Is this while you're in during active service? So there's so much that has to go. And the very first thing I ask all of my clients is what is your long-term plans? Because it factors in. For example, I had somebody who was PCSing here and they said, "Hey, I'm going to be coming from, I just want to be here in 3 years." Great. So did you know you can stack your benefits, that you can reuse the VA home loan? Let's focus on homes that are a little bit on the lower end but that have great rental potential so that you can keep this property and then move on to the next. So it's very important for you to understand what your long-term plan is. Is this your forever home or your starter home, rental in the future? That is the very first thing that I discuss with clients.
Well, and that can in itself be overwhelming because, life changes, and that's okay. At least having a plan helps you structure out your thought process, right? Because then the rest of it, if things shift, you should be able to adapt to that. And I think with that, Lourdes, is really understanding the why, right? Like, why do you want to become a homeowner? Because I'll tell you firsthand, sometimes it's painful being a homeowner because there's all these things that you have to do around the house. Things break, but it doesn't change the fact that if you rent a property, that landlord is making money off of you, and they should be making enough money off of you to be able to pay for those things,
Yeah.
right? So not there's nothing like there's no nothing really is free. Okay, someone has to pay for something, and I know that from personal experience, just like my personally was, we wanted to not move around as much anymore. We want to have kids, so we wanted to be in a school district that we liked. And the challenge we run into when we talk with people is like, I was renting a property. I've been renting here for 10 years. My kids have been going to school, and now we've been priced out of the rental market. But if we would have bought back then, we would have been in a better position. And that's, again, not a pitch to like, hey, get a mortgage. It's just understanding your circumstances and what makes sense for you. But with that, right, Lourdes, I'll tell you that what's this from a song? They say it may be the right you, but the wrong time, or the wrong time, but the right you. I forgot how it goes, but that also applies to housing because the opportunity may be present to purchase a property. But if you aren't ready financially, that causes separate challenges. And that's why we're all about budgeting and credit, because the situation may line up to be that, what, we think we're ready, or like we found an opportunity to buy a property. We don't have to rent anymore. You're not financially ready. Loris, you want to talk about a little bit about that? And then I'll kind of like take it away too with some of the factors. But from your side, what is your consideration with that?
Yeah. So that's question number two. Long term one. Second is budget. What is your monthly budget? And I say this, and you probably heard me, like a broken record,
Hmm.
but like establishing your monthly budget, who cares about what your pre-approval amount is? I mean, well, I
But
guess it's important, but is understanding how much you feel comfortable spending on your mortgage. And I say this with because I've been there and I was house poor where my mortgage was so high because I wanted this big old house. My plan was to rent out rooms on Airbnb and have that pay for everything. I mean, the thought was amazing. I made a big mistake and I didn't check to see if they allowed that in the city that
mm,
I was in. And they were like, yeah, you can't even have a roommate here. So I quickly moved back into Chicago. I was like, I can't
mm,
have, shackles and like people tell me what I can do inside my own house. If I want to rent all my rooms out, I could do it. But I was very restrictive in that particular place. So I um I was way over our budget just for us personally, and made that move into Chicago from a suburb. That way I can, one, it went from close to about 3,200 down to 1,200. So it's a $2,000 a month savings, which would have killed it in the Airbnb, like,
Right.
world, but couldn't do that there. So really knowing your budget and understand that we're probably not going to go back into the twos percents like ever, but we may see like a 2%. We may hopefully one day see the fours or maybe the fives, and then that can make a big dip in your monthly mortgage. But definitely establishing a budget up front and making sure that it's not going to cut into your lifestyle or your children's tuition or things like that. So that's a huge consideration.
Yeah, and with that budget, and you made a good. I like the statement you said, lifestyle, because at some point you have to make a decision, right? Unless you make just unlimited amounts of money, where you could like, I can have the lifestyle that I want. I want to do this. I want to do that, and you could do all that, and that's good for you. But
Mhm.
for a lot of people, that's not the case.
Yeah.
So we see people just kind of struggle with that idea, right? That I want the flexibility to travel and do all these things, but then I also want to be able to have a home that I want to come to home to that I like, right? And what that kind of goes into, Lourdes, is that budget, right? Do you buy a starter home the first time knowing that you're going to sell within 2 to 3 years? Or do you go to a little bit higher because, as we know, historically values continue to go up, even when there's major dips like the 2008 crash? So even if you bought a home at that point when it was the highest, you'd still be doing very well in most markets. Okay, so that's just something to consider in that piece. And what you mentioned, Lourdes, I get a lot of, I'm waiting till rates are 2% to buy again. I'm waiting for 3% or 4%. And the challenge with that, if you look at again historically looking at the data, is every time these rates drop a lot, what happens to home values?
They go
They
up.
skyrocket.
Mhm.
And so then once again you're in this a vicious circle trying to make that decision. But again, it's not for everyone. If you're moving around a lot and you don't know where you want to be, definitely homeownership is something that you would put on the back burner. But for some people, like you mentioned, Lourdes, we have a lot of that where they're like, hey, this is where I want to retire. I want to at least buy a home today in the area that I'm in. We see a lot of that personally from like the Virginia area with all the military folks. They're like, yeah, prices are expensive now, but just imagine what they're going to be like in 5 to 10 years. But they kind of look at it as an investment now to use their VA benefits while they're living there, turn that into a rental, rent it to multiple,
Mhm.
like you said, multiple rooms to different military members, cover their mortgage payment. And then when they come back and retire in 6 years, they at least have locked in that equity at that time, right? So those are all considerations going through the process. It's going to be your family, it's going to be your work situation, right? A lot of people bought homes during COVID, and guess what? Like government employees or people that were working remote, and guess what? They had to go back to work, and now they have to sell a lot of property, or
Yeah.
they sell their property or rent it out. Luckily, during that time, they got great rates. They probably make out on rentals, right? So, but again, that's just some consideration when you're thinking about that. And then for others, like with VA disability income, I know that I've been receiving a lot of those lately, where someone's been awarded 100%. They're like, "Hey, I got my 100% rating. I don't have to pay property taxes in the area I want to live anymore. That saves me $600 a month. It's basically what I'm paying for rent. I want to move forward with it." So that's kind of circumstantial too, right? So take advantage of those things. Um, so yeah, and make sure, like Lord has said, like double check the area you're moving to. What if you want an Airbnb, what those rules are.
Yeah.
If you want to, because I know I have a place right now where they don't allow it, right? And by you, they have a restriction if you have a multifamily on how many units you can rent without having some kind of special permit. And then same thing with the tax breaks. Everyone thinks that, oh, I'm 100% PNT. Oh, I get a tax break everywhere. That's not the case. And
Mhm.
some states require 100% PNT. You could be 100% TDIU and you
Yeah.
won't get it. right? Illinois is one of the ones that's 70% or higher, 250 or less equalized assessed value. You get that portion taken off. So those are just again things to think about, and that's what we do on the channel, right? So if you're thinking about using a VA home loan, you can contact me, and I'll set everything up for you and help you through that process. Lourdes has been amazing with just helping folks out on the real estate side if anyone needs help. So it's been pretty good. So Lourdes, what else do you have to add?
Okay, so the next thing I want to talk about is saving up for all the upfront cost. Because
Yes.
that is, like, huge. Two parts, everybody thinks that, "Hey, I don't have to put any money down. I don't have to pay anything to buy a home." And, most of my clients, they get paid to purchase homes. But if they're selecting in an area that's very competitive, there's this thing called closing costs that
Yes.
we're like, "Wait a minute, but I have to put no money down." That's correct, 0 money down. But closing costs is all the fees that you have to pay to close on a loan. Um, and it can vary. Some places in the US, it's 1%. I'm in the 3% part of the world, for closing costs. So definitely, like David said, reach out to us and then we can connect you with, a local expert in your area and they can go over, what are the closing costs, how much is the average, you know, and that is very important. And I'll tell you why. So we have many veterans, and they say, "Hey, I have," and actually, I was one of them. I have $1,000 to my name. I want to buy a house. Well, we got to put earnest money down, which is typically 1% of the purchase price. And that takes the property off the market. And that's where people say, "Hey, this says contingent or pending and things like that." This is the money that takes it off the market and changes that status. So there's the earnest money, there's money for the inspection. Now, inspections are not, you don't have to have an inspection with the property, but it's highly recommended because they're going to see things that you can't see when you're just walking through the property. They're going to check everything like the roof, the walls, the foundation. There's sewer scopes to check the plumbing line. I mean, there's all different types of inspections that you can get. So you have to save up for that. And then there's the appraisal fee that you have to pay out of pocket to the bank. And they will make sure that you're not overpaying for a property. Even if you want to overpay for a property, they won't allow it. So that is another that's another expense that you have to come up with. And then sometimes, for example, you see a property that you fall in love with and they have a term called as is, meaning the sellers are not going to fix anything. And you are like, I want it. This is a property, we had a recent individual who had to go out there and paint the garage so that they can, because there was peeling paint and the sellers refused to do it and they were going
Yep.
to kill the deal. And we had a veteran say, "You know what? I'm going to go out there and paint the thing. Give me permission." And they did. They went out there, straight painted. We closed, no problem, because they didn't have the money to put aside to, because you have to put a substantial amount of money aside, so just making sure that you have extra funds when you going and you're doing this process, because on the great side of it, if you are in an area where it's not competitive and we can get the sellers to pay for the closing cost credit, that's great. But if you're in an area where the it's a very competitive and they're not offering seller concessions, then you have to make sure that you have that money to close on a property. So, I have some clients that say, "Hey, Lourdes, like, I really love this area, but it's a very competitive market. I'm going to shift my focus to this area where I can have seller concessions and
That's
we're able
awesome.
to purchase and stuff like that." So, just understanding that dynamic and getting all the upfront fees and costs, making sure you have that money set aside, and then the second part of it is making sure that you have money for home ownership. And that's after you close. You want to make sure that you set aside some money. If, like, I had another client, the sewer line was kind of jacked up. that they had money set aside for that sewer line if they needed to replace within the next 6 months. And I'm like, do you have it? Because we only have about 6 months. That includes a roof, that includes mechanicals, that includes all the things. Do you have this money set aside in case this mechanical, this part of the home, that's a very important structure of the home, is not going to make it within the next 6 months, 1 year, 5 years, 10 years, etc. So just making sure that you have those funds set aside for a rainy day. Because let me tell you, when it rains, it pours.
Yes, yes, I had that happen recently. The roof was leaking. So, couple things to cover with Lord is what you said.
Sorry.
So, one common misconception is that veterans have a VA disability rating. They think they don't have to pay closing costs. Okay. The only thing that you don't pay for is the VA funding fee. If you have a 10% or greater rating at the time of closing, right? So if you don't have a VA disability at the time of closing, but you filed your intent prior and you get your disability rating a year from now and it's backdated to before you closed, you then will ask the VA for a refund. So that's something important to know. And to clarify, one thing Lourdes talked about was the appraisal. So when you do a VA home loan, you have this VA mandatory escape clause, which essentially you sign and the seller sign, that says that if the property appraisal comes in lower than the purchase price, which would they would have to issue Tidewater, and I did a whole video on that not that long ago, so you guys can check that out. But essentially, if it comes in lower and you can't negotiate the price, then you can cancel the contract and essentially get your earnest money back. Getting the earnest money back, that's a whole separate video on how that process works because every state area is completely different on who holds the money. But you can, because we've seen it, if let's say the appraisal, let's say the purchase price is 500,000, but the appraisal comes in at 480, right? Either you negotiate that or you go in the middle, or some veterans are like, I want the house no matter what. I'm paying 20,000 over. And the VA will allow you to do that, right? So there's no restrictions as long as you have the money or you can get a gift for that money. So just important to note that is an option because a lot of times I think people worry Lourdes about the appraisal because they're like, oh, well, the VA has a bad rep. And it doesn't. Okay. We had a recent Tidewater issue come up and it ended up coming up above appraised value after submitting the correct comp. So,
Love it.
the VA itself, and I would say, Lourdes, this is probably another topic with the finances is that the VA loan is pretty flexible, okay, with qualification, right? So you have I need to save money for closing costs, or I can get a seller credit. So understanding that part.
Mhm.
And a lot of people too make money. Like we have somebody getting $7,000 back at closing right now, right? So you can make money even buying a home, but you have moving costs, right? You have the house costs, moving costs, and closing costs. Like I can't, my back's bad, so I can't move myself no more, right? So I got to hire people, right? So that costs money. So you want
Mhm.
to factor that in. Sometimes Lourdes people have to do two moves. They're selling their house, they have to then move it to storage, move with in-laws or something, and then they have to move into their permanent home, right? So those are all things that you want to consider in this process. And putting it all on credit cards isn't the answer, right? You want to be able to save that money and have that money on hand.
Yeah.
But again, that's why it kind of goes back to your budget and what you need to do. So I think, Lourdes, we covered some good topics today. We'll definitely be doing a lot more videos around this subject, just because I think it's very relevant for people to understand when is it really that time for them to go through this process or really continue to rent. So thanks for being on again today, and make sure you guys hit the like and subscribe button, and we'll catch you guys on the next video.